UK house prices have soared over 80% in the last decade, but wages? They've barely moved. Now, with interest rates above 5% and mortgage approvals plunging, the once safe property market is showing signs of serious strain. Buyers are vanishing, landlords are selling off, and renters are getting squeezed like never before. Some experts say it's a cooling off, others whisper crash. So what's really going on? Is the UK heading toward a gentle dip or a brutal freefall? The numbers don't lie, but they do raise questions. From debt overload to broken buyer confidence, the warning signs are stacking up. This video uncovers 10 eye-opening reasons why the housing bubble might finally be about to burst. Number 1. Skyrocketing house prices versus wage growth. Over the past decade, UK house prices have risen at a rate that far outpaces wage growth, creating a severe imbalance. According to the Office for National Statistics, the average house price in England is now over 8 times the average income, and in London, it's closer to 14 times. This means that for many working professionals, especially those under 35, homeownership has shifted from a life goal to a distant dream. Even with government schemes and shared ownership models, the gap between what people earn and what homes cost is widening, and it's doing so rapidly. This mismatch creates a highly fragile housing market. When homes are priced far beyond what average buyers can afford, the only thing holding the market up is cheap credit, and as we've seen, interest rates are no longer low. This has led to fewer buyers, longer selling times, and more price reductions. Sellers expecting quick offers are now facing stagnant listings, with some homes sitting unsold for months. Meanwhile, prospective buyers are being priced out or waiting on the sidelines in fear of buying at the peak of a bubble. For investors and homeowners, this signals a potential turning point. History shows that when affordability drops too low for too long, prices don't just pause, they often drop. Whether it's a slow correction or a sharp crash, the foundation of any sustainable housing market must be based on the balance between income and prices. Right now, that balance is broken, and unless wages surge or prices fall, the tension will only grow. The question is no longer if there's a risk, but how deep it might go. Number 2. Interest rate hikes are squeezing borrowers. The Bank of England has raised interest rates from a historic low of 0.1% to over 5%, sending shockwaves through the mortgage market. For many homeowners, this means their monthly repayments have doubled in just 2 years. According to UK Finance, over 1.5 million fixed-rate mortgages are set to expire within the next 12 months, exposing borrowers to significantly higher costs. This shift is particularly painful for those who locked into low rates during the pandemic and are now facing payment shocks of hundreds of pounds each month. Higher interest rates also make borrowing more expensive for new buyers. This results in fewer mortgage approvals, reduced demand, and more hesitation across the market. Estate agents are reporting increasing numbers of price cuts, particularly in cities like Manchester, Birmingham, and London, where homes were already overvalued. The consequence? Sellers are adjusting expectations downward, while buyers wait and watch, hoping for a better entry point. The market is beginning to stall, not due to lack of housing, but due to the cost of financing. This monetary tightening doesn't just affect buyers and homeowners. It impacts the entire economy. With consumers spending more on mortgage payments, less is spent elsewhere, dragging down consumer demand and slowing growth. The housing market, which once acted as a wealth engine, now feels like a weight around the economy's neck. Unless rates stabilize or fall, the pressure on both current and future homeowners will likely continue, keeping housing activity subdued and potentially triggering a broader correction across the sector. Number 3. Declining homebuyer demand. Across the UK, homebuyer demand is weakening at a noticeable pace. According to the Bank of England, mortgage approvals have dropped by nearly 25% compared to the previous year. This isn't just a temporary dip. It's a signal that confidence is fading. Buyers are pulling back due to a mix of high interest rates, inflated house prices, and a growing fear that purchasing now could mean buying at the top of the market. Even traditionally resilient segments like first-time buyers and property investors are showing signs of hesitation, with many choosing to wait for prices to correct. On the ground, the shift is becoming more visible. Estate agents report a rise in price reductions, longer listing periods, and increasing use of buyer incentives. In some regions, sellers are being forced to drop asking prices by 5 to 10% just to generate interest. The once frenzied bidding wars are being replaced by stalled negotiations and lowball offers. For sellers, it's a sharp change from the post-pandemic boom. For buyers, it's a waiting game, guided by caution rather than urgency. This decline in demand doesn't just impact sales, it affects sentiment, and sentiment drives the market. When people believe prices will keep rising, they rush in. When they expect a fall, they pause, and that pause can lead to a chain reaction. With fewer transactions, the market loses momentum, and falling activity often precedes falling prices. In short, the lack of demand isn't just a side effect, it's a warning sign. And if nothing changes, it could become the spark that tips the market into a more serious decline. Number 4. Renters can't catch a break either. While much of the focus remains on buyers and homeowners, renters are facing their own crisis, one that's fueling pressure across the entire housing ecosystem. According to Zoopla, the average monthly rent in the UK has now surpassed £1,300, the highest on record. In cities like London, it's even worse, with average rents hitting over £2,000. For many renters, this means spending over 40% of their income just to keep a roof over their heads. This leaves little room for saving, particularly for those trying to scrape together a deposit to get onto the property ladder. This rising rent burden is creating a dangerous cycle. As fewer people can save for a down payment, demand for rental properties grows, which pushes rents even higher. Landlords, facing increased mortgage costs and tax pressures, are passing expenses directly onto tenants. Some are even selling up, reducing rental supply and intensifying competition. For families, students, and low-income workers, this means more time spent in insecure housing, more relocations, and greater financial stress. What does this mean for the broader housing market? A generation of renters locked out of ownership means less mobility, fewer first-time buyers, and more strain on social housing. The knock-on effect is a bottleneck in the property market, where people can't move up or down the ladder. This stagnation weakens overall demand and adds to the structural imbalances already threatening market stability. In short, the rental crisis isn't separate from the housing crisis, it's fueling it. And until rents stabilize, housing affordability across the board will remain under intense pressure. Number 5. Over-reliance on Help-to-Buy schemes. For years, government initiatives like Help to Buy were marketed as solutions to the affordability crisis. In reality, they often acted more like a band-aid on a much deeper wound. These schemes allowed buyers, many of them first-timers, to purchase new-build homes with as little as a 5% deposit, supported by government-backed loans. While this initially stimulated demand and boosted homeownership rates, it also led to artificial price inflation, particularly in the new-build sector, where developers knew buyers had extra financial support. Research by the National Audit Office found that many Help-to-Buy participants could have purchased without assistance. Yet, the scheme inflated prices by encouraging buyers to stretch further than they normally would. Developers responded by raising prices, knowing demand was subsidized. The result? Buyers often paid above market value, and now that Help-to-Buy has ended, many of those properties have lost value, leaving owners in negative equity. It's a harsh wake-up call for those who believed they were making a safe investment. The real danger lies in what happens next. With these schemes gone and no major replacements in sight, demand for overpriced new builds is falling. Builders, once reliant on guaranteed demand, are now facing unsold inventory. Some are offering steep discounts, signaling a lack of buyer confidence. This could create a ripple effect across the entire housing sector, especially if prices in the new build market start dragging down overall market values. In the end, schemes meant to stabilize the market may have only made it more fragile, a risk that's becoming clearer as the dust settles. Number 6. House building slump. Despite repeated government promises to build, the reality on the ground tells a different story. According to the Home Builders Federation, new housing completions have dropped by over 12% in the past year, with planning approvals also declining sharply. The reasons are clear. Rising material costs, labor shortages, and uncertainty in demand are making developers hesitant. Many construction firms are delaying or canceling projects altogether, worried that completed homes won't sell in a cooling market or won't sell at prices that cover costs. This slowdown creates a strange paradox. On one hand, the UK is facing a severe housing shortage, especially in urban centers where demand remains strong. On the other, buyers are pulling back, scared off by high prices and unaffordable mortgage rates. Developers are caught in the middle, unwilling to flood the market with supply when demand is clearly softening. Instead of helping ease the crisis, this lack of new housing is contributing to a stagnant and uneven market, where certain areas remain overvalued while others face a price correction. The slump in house building doesn't just affect buyers and sellers, it hits the entire economy. Fewer homes being built means fewer jobs, less tax revenue, and lower economic activity. It also means a longer recovery once the market stabilizes, as the construction pipeline will need time to ramp back up. Most critically, it removes one of the key safety valves in the housing system: new supply. Without it, the market remains vulnerable to shocks, and affordability issues will only deepen, even as prices begin to soften elsewhere. Number 7. Investor sell-offs are gaining pace. A quiet but powerful shift is happening behind the scenes. Buy-to-let landlords are leaving the market. Over the last 18 months, thousands of property investors have begun to sell their rental homes, driven out by a perfect storm of tax changes, rising interest rates, and tighter regulations. According to data from Hamptons, landlord sales are at their highest level since 2016, with some regions like the Southeast and Midlands seeing especially sharp exits. This wave of sell-offs is flooding certain local markets with supply, but without enough buyers to absorb it. Why are landlords jumping ship? First, changes to mortgage interest tax relief mean they can no longer fully offset costs, especially as monthly repayments soar. Add in new energy efficiency regulations, looming rent controls, and more tenant protections, and the profit margins shrink fast. For many small landlords, it's simply no longer worth the risk. So they're cashing out, even if it means taking a hit on price. And as more follow, that extra inventory starts to drag down local property values, especially for smaller flats and low-end homes. The implications reach beyond just investors. As these homes leave the rental market, rental supply tightens, pushing rents even higher for tenants. At the same time, if sales pick up in low-demand conditions, they could depress prices for everyone. First-time buyers might benefit from slightly better prices, but many still can't afford to buy due to higher borrowing costs. The net effect? A housing market losing both rental options and buyer interest, a dangerous mix. This shift in investor sentiment marks a clear warning. When landlords exit en masse, the market doesn't just rebalance, it weakens. Number 8. Household debt is near record highs. Across the UK, household debt levels are climbing, creating a hidden risk in the housing market. The average UK household now carries over £65,000 in total debt, including mortgages, credit cards, car loans, and other borrowing. What's most concerning is that this debt is growing faster than incomes, especially among younger families and first-time buyers. With inflation still squeezing real wages and the cost of essentials rising, many households are relying on credit to cover basic living expenses. This adds long-term financial strain that weakens their ability to take on or sustain large mortgages. This financial pressure becomes even more dangerous when interest rates rise, as they have since 2022. Higher rates increase monthly payments not just on mortgages, but on credit card balances, overdrafts, and personal loans. For families already stretched thin, even a small rise in repayments can trigger a cascade of problems: missed payments, credit score damage, and in severe cases, forced home sales. This increases the risk of distress selling, especially if home prices begin to fall, which would trap borrowers in negative equity and further stress the system. Debt-driven fragility doesn't just affect individual households, it impacts the entire housing market. When large numbers of people are financially vulnerable, the market becomes less resilient to shocks. A recession, job loss, or another rate hike could push many to the edge. This scenario doesn't require a sudden crash, it's a slow, grinding drag on the system, where consumer spending drops, housing activity slows, and the market enters a prolonged period of weakness. Without action on wages, affordability, or borrowing costs, household debt could quietly become the next major trigger in a broader housing downturn. Number 9. Global economic uncertainty. The UK housing market doesn't operate in a bubble, it's deeply connected to global economic forces. Events far beyond British borders are now casting long shadows over property values, investment trends, and buyer confidence. From rising geopolitical tensions in Eastern Europe and the Middle East to ongoing supply chain disruptions and volatile energy markets, uncertainty is reshaping the financial landscape. These global shocks lead to inflationary pressures and influence how central banks, including the Bank of England, set interest rates, which in turn affects mortgage affordability across the UK. One major consequence of this uncertainty is the withdrawal of foreign investment from the UK property sector. International buyers, once key players in cities like London, are now holding back due to currency fluctuations, stricter regulations, and fears of falling prices. According to Knight Frank, overseas investment in UK real estate has dropped by over 30% compared to just 2 years ago. With fewer cash-rich buyers in the market, high-end properties are sitting longer and sellers are being forced to adjust expectations, sometimes significantly. Global uncertainty also dampens consumer sentiment at home. When news cycles are dominated by conflict, financial instability, and recession forecasts, people become more cautious with big decisions, like buying property. Confidence is a powerful force in real estate, and when it weakens, so does demand. This hesitation ripples through the entire market, causing delays in transactions, reduced price growth, and a shift toward defensive behavior. Until global markets stabilize, the UK housing sector will remain exposed to external shocks, with fewer safety nets and more reasons for buyers and investors to wait rather than act. Number 10. Market sentiment has turned negative. Perhaps the most subtle but powerful force shaping the housing market right now is sentiment, and it has clearly shifted. For years, UK property was seen as a can't-lose investment, with prices rising steadily regardless of economic ups and downs. That confidence is now fading. According to a recent YouGov poll, over 60% of UK adults believe house prices will fall over the next year. When the majority expects a decline, fewer people are willing to buy, and more consider selling, a mindset that can accelerate a downturn, even before the data reflects it. This shift in sentiment affects every level of the housing market. First-time buyers are holding off, waiting for better deals. Homeowners who might have moved are staying put, wary of selling in a falling market. Even seasoned investors are pausing their portfolios, afraid that today's purchase could become tomorrow's regret. Estate agents are reporting higher numbers of withdrawn listings, and developers are scaling back launches of new build projects, anticipating reduced demand. It's not fear-mongering, it's a natural reaction to an uncertain climate. When optimism disappears, the market changes. Real estate depends not just on data, but on emotion. Trust that your home will hold or gain value. Once that trust breaks, the effect can be powerful. People spend less, move less, and default more easily under pressure. Prices don't have to collapse overnight. Even a slow, grinding decline can reshape the landscape. Confidence is the glue that holds the property market together, and right now, that glue is starting to crack. The question is whether it can be rebuilt before deeper damage sets in. The UK housing market stands at a crossroads, caught between rising debt, shrinking demand, and shifting public mood. What once felt unshakable is now under pressure from all sides. The numbers speak volumes. Skyrocketing prices without wage support, landlords leaving in record numbers, and homeowners facing crippling mortgage renewals. Every sign points toward a system that's out of balance, and when markets lose balance, they eventually reset. Whether that's through a slow correction or a sharper fall, the message is clear. This is not business as usual. We've now explored 10 powerful reasons experts are sounding the alarm, not to panic you, but to prepare you. Because when housing becomes a risk rather than a refuge, it affects everyone, not just buyers and sellers, but renters, workers, families, and the wider economy. It's no longer just about owning a home. It's about understanding the forces that shape our lives and futures. Now, we want to hear your voice. Do you think the UK is heading toward a housing crash, or will it bounce back stronger? Maybe you've already seen signs in your own area, more for sale boards, price cuts, or empty viewings. Tell us in the comments. Your insight could be the missing piece someone else needs. And before you go, check out our previous video where we break down how rising interest rates are changing the rules of the game for millions. If you found this video helpful, support our channel. It's just one click to subscribe, but it means the world to us. We put a lot of time and research into each video to give you real value. Let's keep learning together.